Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis on Thursday, October 9, 2014. Whoa. So certainly didn't anticipate this kind of down day today. As we spoke yesterday, the big up day, I said normally you would have some follow through for a couple of days, maybe come into these moving averages, and then we'll see what happens. Well, the market reversed today. And if you remember last night, I told you that I looked at the TLT and I told you that the bond market I thought should have went down. I thought rates should have went up. I thought the bond prices should have went down based on yesterday's move up in the stock market, because I showed you they've been moving inverse to each other. And I said, that was a tell that was bothering me. I don't know what to make of it yet, but it was something that didn't jive. Well, guess what? I don't know. That had nothing to do with the reason the market went down, but it was a tell. It was just something of caution, and we look for those things. That's the common sense part of what we do. Okay, so we had a whopper of a down day. And you can blame it on Ebola. You can blame it on the Middle East. You can blame it on Mario Draghi's comments from the European Central Bank. You can blame it on the global economy. They blamed it on the kitchen sink today. It didn't matter. In the same segment, I heard three different reasons why the market was down in a 2-minute span on CNBC. I mean, it was ridiculous. On one hand, it was Ebola. On the other hand, it was the global economy stemming from Europe and deflation and all that jive. So, basically, it doesn't matter. The market got hammered today. So what happened? Basically, we just started down, and normally there were probably some buyers in here. You know what? Let's look at the 10-minute chart, because here's what normally happens, right? Normally, where are we? Okay, so normally we're here. You would have some buyers early in the morning after a big down day. Let's say the market opens down a little bit, and then it begins to kind of catch a little bit of a bid. Maybe it's down a few points, and then all of a sudden we take off to the upside again on a follow-through day. And worst case, we get a little bit of upside, maybe a pause day, but usually there's some follow-through at some point during the day, and it never happened. It just went relentlessly down all day long. And when you look at one of the tells that we look at as traders in the market is how are the transports doing intraday relative to the market. It doesn't tell you everything, but the transports were getting hammered today. They were down 200 points. They were down 150, 175, 185, 90 all day long. And when the transports are down that big and some of the other indexes are down that big, I mean, the broker-dealers got hammered today. They were down like $4. When you see stuff like that, there's no upside to be had. There is no buying bounces, okay? When you have one of those days where the market's down, but you have some sectors up and you have other stuff going on, you can buy certain things because there are some disconnects when it's a kind of a calmer market. Some sectors can rally and some sectors don't have to rally. And on days like today, when it's a 90% down day, everything gets thrown out with the bathwater, and it's basically just a relentless anvil on your head down day. So you can't buy into that. You have to sell into it. You sell the bounces instead of buying the dips. They say sell the rips instead of buy the dips. So that was it. So what do we have for tomorrow? So interestingly enough, let's look at the daily chart. All right, because we're in a good spot. We're in an interesting spot. We're probably not going to hold this level here if we continue to have these big whipsaws right above it, right? Because this level would hold if it came down into it today, for example. It would have had a huge bounce, or it would have at minimum held. But if we have another couple days like this, this level is not going to hold this low here and the 200. And if that's the case, then, you'll come down. Let me squeeze this together and I'll show you what we're looking at. you're looking at either this area here or in this neighborhood here. So we're going to call it 185 to 186, right? We never have to get it to the penny. 185 to 186, probably this pivot low is like the greatest spot in the world at 185. Yeah, 185. This pivot low is absolutely the best spot in the world. But you won't come down there in one shot. But I'm not saying you'll even get down there. I'm saying this should hold. If we came into it tomorrow, would it hold? Yeah, probably. But if we kind of let's say we went sideways down into this thing, just making a series of lower lows and lower highs, then there's no way this holds if the market's still as weak as it is. There's a lot of selling pressure out there, so you have to be very, very careful. You can't buy these dips in a market like this, but you will have a big reversal day like yesterday, and then one of them will have the follow through for a while. But right now we're not in that camp, so buyer beware. So there's probably more downside is my point. Now, you may get some kind of a pivot tomorrow, but all through next week, expect this kind of action. I don't know about the magnitude, 300-point down days or up days, but you're going to get a lot of this up and down movement during options expiration. So, that's kind of the best read I can get it right now. I can't give you a number on the downside other than worst case down here. If we came into here tomorrow, that would probably be a great level to buy. But not, if it's not tomorrow, then it probably doesn't hold. That's my take on it. Let's go over to oil because oil got drilled again today. Anyway, that was an unintended pun. So here's the deal. Oil, let me go to my futures chart on the other screen. And the price of oil right now is trading at 84.67, broke 85. So I've been saying 85, give or take $1. So we're in that take $1. There could be another $1 or $2 of downside, maybe 82 worst case in my book for now. But you can get in close to a bottom in oil. So if you're getting close to a bottom in oil, what do you look at? All right, you want to look at some oil stocks. All right, so here's one for you. Instead of oil stocks, because you don't know which one's going to react how, and then you have all that stuff. Buy a fund, right? The OIH is the Oil Sector Services Fund, and it's just made up of all the oil stocks, right? And it's going to move with the price of oil. This is moving with the price of oil. It's moving with the oil stocks. Well, guess what? You're coming into this pivot low here, okay, with this high here and all this support in here and this support here. Look at this. This was support, resistance, resistance, support. What are you going to have here? I hope support. I think this is a buy. You can probably buy this tomorrow on a dip. And you probably get a rally back above the 200 period moving average. And this is the weekly chart. So if you get a weekly close tomorrow, so if it looks like it's going to close at the end of the day below the pivot low here of number is 44.57, if it closes below that number at the end of the day, if that's where it is above or below that number, you can buy it. You can buy it if it's above. You can don't do anything if it's below. That's a trade for you. That should be a good trade. So all right, what else do we have? All right, how about we go over to gold, GLD. Gold was up overnight last night, and GLD was up today. So you basically, let's see, gold is 1224 as we speak. So I said that your top end is 1240 to 1250. I'm going to still stand by that. You'll probably have a little bit more upside to gold. But I still see downward pressure, but we'll play it by ear. Anyway, it's moving up, and that's fine. You may put in a triple bottom here, and then you may get a nice rally off of that, and I may be wrong, and that's fine. I'm just telling you what I see. And then the good news about the way we analyze charts is when you're wrong. So my work tells me that 1250 is a top end. So if I get a weekly close above 1250, I'm wrong, and that's it. So if I want to short gold at 1240, 1250, 1245, okay, and then I get a weekly close above 1250, I'm out. And I'm out with a small loss, right? And any loss should be small. We don't want to have big losses. But if I'm right, okay, So my downside, let's say I thought gold was going to go to 1150, 1130. Just make that up for a second. So my downside is a close above 1250, I'm out, and I have a small loss. But my upside is if it drops all the way down to my target price, I got in at 1240, let's say. 1240 to 1140, just use a $100 number. It's a round number. That's a huge trade. Okay, so you see where you have to know where you're wrong, and your entry point is as important as knowing where you're wrong. You don't want to enter at 1200 if you're wrong at 1250 and be short, because that's painful on the way up, right? So anyway, just a little trade lesson. Okay, we want to talk about anything else? Yes, we do. We want to talk about the VIX. Let's talk about the VIX tonight. It's important. Okay. Is the chart going to come up? Is the chart going to come up? Where is my VIX chart? I'm sorry, folks. Oh, you know what? I was typing it in as the symbol on another platform. That's the problem with using two platforms. I get confused, and I'm going to consolidate soon and go to one platform. There, I said it. All right. So here's the deal. The VIX, let's go back to a weekly chart, because I showed you this, I think I showed you this last night or the night before. And basically, look at this. You are into some major resistance on a weekly basis. So tomorrow being the end of the week, okay, you have pretty good idea of what's going on. Because if you go up and test these highs, okay, and even break these highs and close there tomorrow for some reason, and that could happen, then the market's in big trouble, okay? Because you should spike, just like all these, you should spike and come down within the day. The VIX, on a spike like this, on a weekly spike, will rarely close that way, okay? It does happen, but most of the time you get these kind of spikes with these tails. So on a daily chart, all right, look where we are. If I squeeze this down, last time you were here was in February, and your February high was right around 21.5. So 21.5 is a good number. You can overshoot. The VIX has a tendency to overshoot on the upside and the downside, because it's not like, it's hard to calculate the numbers because it has these enormous swings in the middle of the day on some days like today. So you can have a 10% move in the VIX, and it's very hard to calculate velocity of a move. But if I calculated it and I said if we were going to surpass 21.5, then I would say 23 would be about my maximum that I would see it on any particular day, unless we hung out there for a while. If we stayed up there at 19, 20, 21, 21, 22, 21, day after day after day, then we can fire through it. But on a surge, on a one-day surge, 23 is the top in my book. All right. That's a long one for tonight, but it was worth it. Be careful out there, folks. It's a tough market to trade. You have to be either out or familiar with the charts, because they're hitting levels, but they're cutting through them like butter. And if you don't catch a bounce, if you're a scalp trader, if you don't catch a bounce, then you can get hurt real hard on the downside. So be careful out there. More to come tomorrow. I'm David Frost, mystrategicforecast.com. Thanks for tuning in. Another episode of Common Sense Market Analysis.